Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
What's the biggest concern on the hearts and minds of savers looking to retire worry-free? Well, stay tuned as we answer the third and most concerning question of them all. Is it possible that I could outlive my savings?
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, retirement specialist and six-time author and fiduciary, Tony Walker.
One of the worst feelings in the world is being retired and then all of a sudden realize that due to the amount of risk you are taking, you might just one day run out of money. Over the past 2 weeks, we've covered two of the biggest questions on the hearts and minds of savers looking to retire worry-free. Today, we'll tackle the granddaddy of them all, our third question from savers in retirement: is it possible that I could one day outlive my savings? And why do so many savers worry about one day running out of money? Well, in most cases, the sole reason is that they know they are taking too much risk with it, yet not realizing that in many cases they don't have to. Because let's face it, unless you have in place some source of guaranteed income for life, something we call mailbox money, then how in the world are you going to sleep at night knowing that you could one day run out of money due to a stock market crash or even plummet in value, which it did in 2008? So how do we make sure our clients can comfortably spend and enjoy their money in retirement without the fear of one day running out? Well, let's find out. Well, welcome, folks, to the Worry-Free Retirement. And yes, I am that little man in the sweater vest retirement planning specialist and full-time fiduciary, Tony Walker. And today we're going to share with you the answer to this long-standing question on the hearts and minds of savers everywhere, and how we at Tony Walker Financial are uniquely experienced to help savers worry less about money. But before I get started answering this most important question in retirement, let me introduce two young lads who help produce this show each week: America's favorite financial sidekick, Mr. Aaron Orender, along with Louisville, Kentucky's most laid-back graphics artist, Mr. Derek Hudson. So why is this question even an issue today? I mean, let's face it, the idea of running out of money in retirement was foreign to folks back in Granddad's day. That's because most of he and his compadres enjoyed something called a pension, or what we call
mailbox money.
Since this generation of savers had pensions, there was no need to take unnecessary risk by investing their money in the stock market. The very thought of running out of money with these pensions, well, was no thought at all, because the pension and its mailbox money guaranteed that Granddad and his buddies would never run out of money. In other words, he didn't have to worry about running out of money like savers do today. So think about why you are taking so much risk with this money. You work 30 or 40 years saving away for retirement, only to keep risking it for the chance of having to maybe have to go back to work one day if we have another '08. Folks, it can happen, and it did happen. So again, it begs the question, why are you taking so much risk with your money in retirement when you probably don't have to? So how do we at Tony Walker Financial answer this question of using and enjoying your money, reducing risk, and live without this fear of one day running out of money? Well, stay tuned as I share with you the only guaranteed way to make sure that doesn't happen and how we at Tony Walker Financial can help. I am Tony Walker. You stay tuned, and we'll be right back.
Hi, this is Lisa with today's most commonly asked Social Security question. How do I earn Social Security credits to be eligible for benefits? Most jobs take Social Security taxes out of your paycheck, so you will be eligible for a monthly benefit. However, some jobs, like state and town government positions, don't pay Social Security taxes and therefore don't contribute to your eligibility. You will be eligible for benefits on your own work record if you are age 62 or older, and if you've worked and paid Social Security taxes for 10 years or more, which is also referred to as having at least 40 credits. You can log on to ssa.gov and create an account to see if you're eligible.
Our Tony Walker Financial 5-star review comes to us from Steve, who says the following. I feel really confident in where Tony has us in regards to our financial situation. The entire staff is absolutely great to work with. I highly recommend Tony Walker Financial. For more information, visit TonyWalkerFinancial.com or call 877-499-9255.
Welcome back to the Worry-Free Retirement, and as we conclude this three-part series on the three biggest questions on the hearts and minds of savers in retirement, you got to love this one. The big kahuna of them all, is it possible that I could one day run out of money? So the way we solve this problem is through something called mailbox money. And basically there are three forms of mailbox money out there. There's pensions, Social Security, and private annuities. Of course, we at Tony Walker Financial, that's what we specialize in, is not only forecasting and trying to help you think through when to take Social Security, how to minimize taxes. We have all that stuff down. We understand Social Security very well. But we also can set up those annuities, which are the only product that can provide the guaranteed mailbox money. In fact, over the years, we've accounted for writing over $700 million of annuities. So we know these products very well. By the way, if you're getting ready to be pitched one, if you've gone to a dinner seminar or library, folks, they're going to be pitching annuities. Please at least get a second opinion from us before ever purchasing the annuity. And in many cases, what I would say is, if you're going to purchase an annuity without a game plan, let the buyer beware, because it's probably going to come back to bite you at some point down the road. Now, I want to focus on one of the main mailbox monies that most people have, unless you're a teacher in the state of Kentucky, but that would be something called Social Security. Now, there's a lot of concerns about Social Security. Depending on what the trust fund says of any given year, it's either 2033 or 2034. They kind of bounce back and forth. But basically, by those years, it's supposed that the Social Security system will be insolvent. It's going to be out of money. However, it's very interesting. If you'll notice, next year, in 2025, the Social Security Administration is going to up the ante and increase Social Security benefits currently being paid by 2.5%. This is called the cost of living adjustment, or COLA. Now, I'm not opposed to them increasing it. I think that's great that people are getting more money. I know they need it, but you got to ask yourself, wait a minute, if this system's going to be bankrupt theoretically in 2033 or 2034, how come they're doling out more money, and how can they do this? Well, you got to read a little farther in the article. If you go down to the very bottom, this is interesting. And this proves my point I'm getting ready to make in just a second. But note here at the bottom, it says the maximum amount of earnings subject to the Social Security tax. Now, hang on there for a minute. This is dealing with the people that are making these incomes between 168 and below. Okay, that's subject to the FICA tax, which is over 6%, and also the employer has to match that. So that's 12% in taxes going in, but notice they've increased that to 176. So take that example. Let's say you're making $180,000 a year. Well, this coming year in 2025, your FICA taxes will actually go up, and I guess they're going up to help pay for these increases. So folks, in a nutshell, here's what I would say about Social Security and the system and fixing it. They're either going to have to reduce benefits, increase taxes, or both. That's the only way to fix the system. And finally, I would say this about Social Security. There is no one-size-fits-all, folks. Many people are getting so confused on when to take it. I would say this. If you don't have a written game plan in place, it's like throwing a dart at a dartboard. Good luck figuring out when to take Social Security, which is why we always ask people to contact us. If you're thinking about when to take Social Security, let us talk to you. If you're a prospective client for Tony Walker Financial, we'll take you through that free process to show you how our game plan works, and then make the decision on Social Security. Okay, in our time remaining, I got to go over this. This is a great quote. This is from a mentor of mine, Mr. Bob Castellone, and he basically said this: "A dollar is not worth anything until it is converted to cash and used." So our theme has kind of been not running out of money, and I'm kind of bleeding into this idea of many people not using and enjoying their money. So let me show you an example of this, of what happens when you stockpile money, and what Mr. Castellone is talking about, and how I see this play out day in and day out. And in fact, this is why I wrote the book, Live Well, Die Broke, to help people understand that you're not going to live forever. You can't take it with you. And many clients I meet, again, we've got over 3,000 clients. Most of them are retired folks. I've got a lot of experience in this, but many people wait way too long to spend and enjoy this money. So the idea is, what is something really worth, all right? And in this example, we've got a 62-year-old who has $1 million 401k plan, and they're still working. They don't need the money, and they've been told, they saw an article recently, that you need $1.4 million to retire comfortably, or whatever that magic number is. And I say that's fine. But what is that 1.4, even if you get there, really worth? So we're imagining down the road, they get to the 1.4, and they're getting ready to retire, and guess what? We repeat a 2000, 2001, 2002. What if the market goes through that again? Well, let me show you what's going to happen. The market in 2000 went down 23%, so that means this account would drop in that year by $322,000. The next year, 2001, the market dropped 13%. It would lose another $140,000. This isn't looking good, is it, for retirement? 2002, it dropped 10%. That's another $93,000. That means the balance of this 401k now, listen to this, is a whopping $845,000.
That's too bad.
So much for using and enjoying your money while you still could. And we haven't even paid taxes on it. Depending on the tax bracket, I mean, let's say he's now in a 30% tax bracket. Who knows what they're going to do in the future? What is that? That's about another $250,000 that Uncle Sam's going to get. You got inflation. Maybe inflation eats away another $200,000. So now we got $450 after $845. And at the end of all these deductions and everybody getting their hands in your pocket, that original $1.4 million, again in this example, a market correction, taxes, inflation, you got about $400,000 left.
Heavy.
Now, Wall Street would jump in and say, exactly, that's why we don't want you spending your money. What Tony Walker would say is, no, that's not the point. The point is this dollar today is worth a whole lot more money than potentially what could happen to that dollar tomorrow. So this is why we don't like our clients, when we get into retirement, assuming they're savers, taking all of this risk. This risk could wreck your retirement, folks, and that's the other reason we want this mailbox money in place. So that's you right now. You might be sitting there saying, Tony, I've never thought of it this way. I've just been told to save, and stockpile money, and as we'll talk in a minute with the Bible, build bigger barns. I mean, what's that all about? You've got to get a game plan, folks. You've got to get with a retirement specialist that understands this world. I've been working in this field for years. We have over 3,000 clients. I've orchestrated and overseen more than 5,000 written game plans. We know what we're doing. So if you're a saver, why don't you do this? Log on to TonyWalkerFinancial.com. Click on that Let's Get Started. Let's have a no-obligation phone call. We call it the free 10-minute fiduciary phone call. We can arrange that call at any time. And if you like, you can call us 24/7. We have operators standing by. If it's in the after hours or weekends, just call 877-499-9255. Well, speaking of bigger barns, the Bible addresses this very fact. If you're saying, well, Tony, I don't have any barns. Yes, you do. You got a 401k or an IRA that needs to be protected. I'm going to show you how to do just that. Let me get a cup of coffee. I'll be right back. With the uncertainty of the stock market, our nation's debt spiraling out of control, and inflation running rampant, now may be the best time to consider moving your 401k to safer territory. My name is Tony Walker, and for over 38 years, I've made it my life's mission to help savers worry less about money, and I want to help you too. To speak with me at no cost or obligation, why don't you log on to TonyWalkerFinancial.com or simply call the toll-free number on your screen. Have you recently retired, been laid off, or offered a pension buyout? Has the company you work for moved, been acquired, or closed its doors forever? And finally, do you have a 401k with a previous employer you'd like to move to safer territory? Then take advantage of this opportunity to move your 401k or lump sum pension to Tony Walker Financial. Let's meet in person to discuss your retirement options. Log on now to TonyWalkerFinancial.com to schedule your free, no-obligation appointment. Let us help you today. Due to the complexity of the tax laws surrounding one's 401k plan, many savers are led to believe that if they retire prior to age 59 and a half, just had this come up the other day with a 55-year-old, that there is no way they can touch that money inside that tax-infested 401k prior to age 59 and a half unless they're willing to take an additional tax penalty to get at it, which is not always the case. So let's say we have a John Doe who's age 55 and he wants to retire. He is going to terminate employment. He's not going back to work, and he thinks he might need some money. Why? Because while his wife is still working, again, this case just came up the other day, after reviewing their expenses, his wife's income is not going to be enough to cover all of their monthly expenses. So he feels like he's going to have to drag out some of this money from the 401k, but he wants to know, is there any way to avoid that 10% penalty tax that will be imposed since he's not age 59 and a half? So basically, this person has two options to avoid the penalty. So let's take a look at how that would work. Again, the magical age here is 59 and a half, but actually there's a magical age of 55 that the government has imposed. And I'm thinking you're probably like me wondering who comes up with all these crazy rules. Well, that's what our politicians do. They try to come up with complicated rules. And I guess everybody like myself somehow benefits from it because you need people like us to navigate this stuff, which is what we do at Tony Walker Financial. But in our case, he is exactly age 55. So option one, he would have, and again, we're trying to avoid what's called the 10%, I call it the tax penalty. Option one, and he has another option two. All right, let's start with option one. Option one says that if he terminates employment, this is how the rules state in the law, and he's 55 years or older, okay, terminates employment at age 55 or later, before 59 and a half, option one says he can avoid that penalty if he leaves the money at the 401k, okay? So in other words, this person's retired. He can just leave it there. If the custodian, most of them do allow you to leave it in the form of a 401k. Don't let him move it over to an IRA just yet. Just stays to the 401k. Because he terminated employment at 55 or older, there are no tax penalties. So he could take out money anytime he wants from that 401k. Of course, when he hits 59 and a half, he can take out as much as he wants regardless, whether it's at the 401k or with somebody like us. But what if he says, Tony, I like your game plan, man. I want you to handle everything. I want to bring your firm on board and be my advisor. Can you not handle this 401k? And at the same time, if I take money out prior to 59 and a half, can you help me avoid that penalty? And the answer is actually kind of. We can if we do something called a 72T election. Again, this is a government provision. And what that 72T election says is this. If you have an individual retirement account with us or any other broker, if you take money out of it prior to 59 and a half, you're going to have that 10% penalty unless you do this. Well, what is a 72T? That means, in this case, between 55 and basically 60, it's age 59 and a half or 5 years, whichever is greater, so we'll just keep this simple. So between 55 and 60, we might calculate this 72T. Again, these are government tables we have to follow. But it says, okay, Mr. Jones, if you want to, based on these 72T requirements, we can send you $3,000 a month starting now. It has to remain that way until the 5-year ends, and you cannot change it. And then after that, when you hit 59 and a half, you can do anything you want. So that is an option, and we do these from time to time. They can work very well, and the 72T election can avoid that 10% penalty. So that's you right now. Maybe you're under the age of 59 and a half, and you want to get out. You want to retire, but you also don't want to create unnecessary taxes and penalties. We need to talk. At Tony Walker Financial, we are a full-service, independent retirement planning firm. We have 2 certified tax specialists on staff, and our services come to you at no additional out-of-pocket costs. That's right. All of our planning services are free to our clients. So to learn more about our services, why don't you log on right now to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com, or call us anytime at 877-499-9255. Well, folks, we'll be right back.
So, Trey, Tony talks a lot about continuity and continuation plans and things like that. He always has posed the question, what happens to him, the firm when something happens to him? And of course, we've got the contingency plan built out, but why don't you speak to the importance of the game plan and how us as fiduciaries, we basically share all clients?
Yeah, that's an interesting thing because a lot of firms designate clients. I have friends in the industry that you kind of work your way up based on account size, and that's not the case here. We all share clients. We can pull up the game plan at any given point. there's obviously kind of a natural tendency for Louisville clients to call me or Bowling Green clients to call you, Lexington with Wes, because we're over there more. However, they can call in at any given time and we can pull up the game plan and be able to talk knowledgeably about the entire plan, and they're not going to get different answers from different advisors. So it's the continuity of what we're able to do by referring back to that game plan and monitoring their progress is really what it's all about.
Exactly. Yeah, it's well said. A lot of times it's not even just the game plan, because of the way we handle things and take notes, and we can kind of pick up wherever another advisor has left off. And, I think it's really nice that clients can know that, we're literally here for them.
Yeah, I think probably 25 minutes ago, I had a call in. You were filming the show with Tony, and I was able to refer to a note that you had talked about them last week and provide them just continuity on that answer and tie up what they were looking for.
That's great. Thanks so much.
Yeah, thank you.
Are you retired or retiring soon? Do you have a 401k, IRA, 403b, TSP, or lump sum pension that you'd like to move to safer territory? Did you know that all the money you see on your 401k statement isn't really yours? Depending on your overall taxable income, the government essentially has a lien on your 401k that can tax as much as 40% of your money when you go to take it out. And with current tax rates set to expire in 2025, and considering the fact that our nation's debt is spiraling out of control, do you really think taxes will go down after 2025 or go up? Here's my advice. Don't sit around waiting to see what Uncle Sam will do to your taxes in 2025. If you have more than $250,000 in retirement assets, contact us now by logging on to TonyWalkerFinancial.com or give us a call at 877-499-9255. It is estimated that each day over 10,000 people will turn 65, which means a lot of advisors selling a lot of annuities. Don't get stuck in the wrong annuity. Get a second opinion from TonyWalkerFinancial.com.
The individuals in this interview are uncompensated clients at the time of filming. Their opinions expressed were provided to Worry-Free Productions for use as an advertisement by Tony Walker Financial. Please refer to Form CRS and Form ADV Part 2A Disclosure Brochure for information regarding the advisory services offered by Tony Walker Financial.
Our Tony Walker Financial Client Spotlight today shines brightly on Warren and Betty Henning.
I was born and grew up in San Antonio, Texas. We currently live in Kentucky, in Henry County. There's no real town around, so
I happened to be in the house one day watching TV on a Saturday, and was flipping channels, and Tony was on. And I started listening to him, and whatever he started telling about his concepts, and he started hitting the biblical approach to savings and retirement. That's whenever I said, this is the guy I want to sit down and talk to. And I'll never forget the first meeting with Tony. He asked me one of those questions, why are you here? I want to know if I'm okay or not. Will I have enough money in retirement? And that's one of the things that he's really helped us with. When I knew I was going to retire, I got talking to some of the guys, and they got telling me about people making maple syrup. And the process with it, and just the whole thing started intriguing me. This year we got into maple syrup, making our own maple syrup, and we just love it. It's 220 acres, 100 of it pastures, 120 of it woods, and it's a beautiful lifestyle.
I think as retirement came around, it gave me more time to think about what I really enjoyed doing. So it's like I said, not a one-size-fits-all, but who are you and what do you enjoy doing, and find where you can plug in.
Looking for an advisor you can trust? Schedule your free phone call with Tony at TonyWalkerFinancial.com or call 1-877-499-9255.
Looking to roll over your 401k? Then log on to TonyWalkerFinancial.com and learn just how easy it is to roll over and safeguard your 401k. Do it today. Earlier in the show, we talked about this thing called human nature and the notion that when we start saving money, we begin to think that what we have may not be enough for the future, or for whatever reason, think we should be stockpiling more and more money instead of spending and enjoying the fruits of our labor. Kind of the opposite of what you should be doing in retirement, don't you think? I mean, what is the point of working all these years and saving all of this money for retirement if when you get to retirement, you're not willing to spend the money? This phenomenon that I've watched play out for years is the reason I wrote this book, Live While Die Broke, a book dedicated to helping savers spend and enjoy their money now versus later, and without the fear of one day running out. And it's not just a little man in a sweater vest that thinks you should be careful of stockpiling too much money for the future with no plans to use and enjoy it. Jesus provides an example of a wealthy landowner who made the same mistake. Check it out in Luke 12:17 through 20 as we diagnose and dissect what this landowner was thinking. The first problem this fellow had was he thought to himself. A scary thing to do when you are in the throes of success. I see it all the time. Retirees who have been successful with their money, and instead of getting a game plan to spend and enjoy their money, they start thinking of ways to save more of it. This is especially true when the stock market goes up. Instead of taking some winnings off the table and walking away with the money, in a desire for more money, they leave it at risk and sometimes do nothing. The next part of this verse deals with the next fatal question when confronted with more money than you know what to do with. What shall I do? You know, this wealthy landowner makes the same mistake savers with large 401k plans make. They forget why they produced a bumper crop in the first place. To enjoy it, right? Not come up with a scheme to keep more of it. Translation? Even though this landowner has plenty, he wants more socked away for the future. Verse 18 gets a little scary. Now the guy has a plan where he gets the light bulb moment stating, this is what I'll do. What's he going to do? He's going to build bigger barns. And not just build bigger barns. This fella gets so carried away with building more wealth that he tears down perfectly good barns, spends his hard-earned money, on new ones. Don't laugh. Think about what you yourself might be doing with all that money you've got stockpiled in that tax-infested 401k or IRA of yours. You got plenty of money, but you continue to take risk with it. And why? Well, go to verse 19. Apparently, this fella makes the mistake a lot of savers think they need to make, and that's trying to predict the future and know exactly how long they think they're going to live. But later on, find out there's a huge issue they forgot about, and Jesus tells us that in the next verse, where he basically says, time's up. Result? All that stockpiled money goes to someone else who gets to use and enjoy what you took a lifetime to create. Not what I'd call a very good game plan. Indeed, this parable reminds me of something. One of my mentors, Bob Castellone, taught me about money, a truth that fits right into our topic today, and it's this. $1 is not worth anything until it's converted to cash, listen, and used. A concept that I cover in my book, Live While Die Broke, and why in many cases savers have no need to take so much risk with their money, nor stockpile so much of it by building bigger barns. And maybe that's you right now. You've worked your whole life stockpiling money with no plans in place to use and enjoy it before it's too late. Well, if that's you, we need to talk. And we've made this so easy. In fact, we call it the free 10-minute fiduciary phone call. And here's how easy it is for you and I to get started and talking about your game plan. So basically, folks, if you'd like to talk by phone, all you got to do is log on to TonyWalkerFinancial.com, click on that Let's Get Started button, or if you like, you can simply call the toll-free number at 877-499-9255. Now, what's going to happen is we will arrange that phone call, and if it merits, if I think I can be of help, I'm going to personally meet with you. That's right, the owner of the company. I will meet with you in person at either our Bowling Green, Louisville, or Lexington, Kentucky offices. So do it now. Log on to TonyWalkerFinancial.com or give us a call anytime. Well, we hope you've enjoyed this 3-part series. Guess what? Next week, an interesting show about Monaco and something called the Monte Carlo simulation technique. Good stuff coming your way next week. But you remember, between now and then, if all else fails, you make it a good week.